What I look for myself in investments across land, T-bills, shares, private equity, number one thing you have to always think about is liquidity. When you are buying land, you are buying shares, you are buying boards. When you need the money, how soon can you get it? You know, maybe some of you can relate. This Kenya is full of people full of wealth. Wealth, niko na shamba ya eka 200, 200 acres, 2,000 acres, niko na hii. Okay, fine. You told me how much it's worth. When can you get it? When can you get it? Liquidity is always a very critical thing. And me, I approach life in terms of, I also need money. Because I don't think you're investing money for the next 200 years. You're investing money to help you have a good life continuously. So if you can't liquidate your money, then you have to think about it. Liquidity. How soon can you liquidate that asset you're investing in? Secondly, always do some analysis about return on equity, return on investments, return on assets. Depending. Na mimi nikiangalia hapa hii hall, I don't need to go into details on that. There is something else I always look for in the NSC. I can't buy a share before I look at it, called PE ratio. PE ratio means price over earning per share. So earning per share is what? When the company announces year profits, they divide their profit by the number of shares they have. So what they get is earning for every share. So PE measures how the company is trading in the market, that is the NSC, divided by its earnings. You are able to see if the company can pay dividend the entire amount of money, how long would it take me to recover my money? Currently in the NSC, to the best of my ability, the company with the lowest PE, the lower the better. Because the lower shows the least possible time you can get back your money if you have to rely on net profits. If I buy this company, the net profit per year, how soon can I return my money? So it measures a period, PE ratio. I'm just highlighting so that you also go do your own research. Risk profile, as you invest, look at how risky a thing is. Don't delegate some of these things. You know, many times in investments, you want to, you have an investment advisor. These things, you can do them by yourself. It is your money. Remember that all the time. Even after listening to your financial advisor, it's not their money. It is your money. And you realize you don't need so much time to learn. You can actually do your basic analysis using with very little time. Evaluate the company's fundamentals. This is for shares. Fundamentals means look at which sector are they playing in. For example, now, look at areas that are growing, sectors. So by the time you even zero in on a company, where are they zero grazing? Is it a bank? Is it an IT company? Is it an agricultural-based company? So that by the time you decide, you understand why. For example, if I'm to buy any agricultural company in Kenya, the shares, I will never buy for the profit they make. I will only buy for the asset they hold. And I will only then buy if there is a way I can buy so many shares and cause them to sell that and distribute the money. Because you realize Kapchorwa Tea is one of the listed companies, Limuru Tea, you get Williamson Tea, rich in assets in terms of land. But their profits are always like this. Because agriculture all the time, agriculture is never like this. You make money this time because weather was good. Next year you bump again downwards. So always do that math. If you're doing a company for you to get in substantially, cause the company to liquidate some assets, to pay off a special dividend, it's called stripping of assets. Then I would buy a company rich in assets, but thin in revenue. But in our capital markets now, if you're buying a company or shares, always look for a company making good revenues, but also distributing that revenue to shareholders. So that you look at the fundamentals in that scenario. Their corporate governance, the sector they are based in, how dominant are they in that sector, how much profit do they make, do they have a room to expand beyond the Kenyan market, and such and forth.